Precious metals aren't just rallying. Something underneath the price is snapping into place, and a lot of big money doesn't want you staring at the one signal that proves it, because the billboard price can be argued with, but the spread can't. That's the whole game right now. Not the hot take, not the meme, not the safe haven cliche. It's the machinery. It's the pressure showing up in the parts of the market most people never look at, because it's less exciting than a chart with a rocket emoji, until it suddenly becomes the reason the chart rips your face off in either direction. Here, it's the clean scoreboard. So we not doing vibes-based finance. In the first half of January, gold and silver didn't politely trend higher. They moved like markets move when somebody big is rebalancing risk and somebody else is forced to react. Gold pushed into fresh all-time territory, and silver followed with that familiar too fast, too loud energy that only silver does when it senses oxygen. And then, right on schedule, you got the slap. A sharper retreat day that was instantly wrapped in neat little explanations. Dollar firmer, rate expectations shifting, profit-taking, geopolitics ebbing. Pick your headline. That dump is the part that makes the story credible, because real repricings don't go in a straight line. They spike, they flush, they test who actually has a plan, they punish anyone who's only here for dopamine. But that's not the part that matters. The real part is what the market is quietly admitting through its structure, because structure is where incentives show. It's where the fear trades and the hedges and the industrial procurement all collide. And if you want to understand why precious metals are dominating market conversations, you have to stop thinking of gold and silver as assets people buy, and start thinking of them as stress sensors inside a system that runs on leverage collateral and confidence. When those sensors start screaming, everything else gets louder, and that's when the conversation shifts from "is this a trade?" to "what does this say about the regime?" Now let me give you the hidden detail up front, because I'm not going to drag this out for 10 minutes like a cheap thriller. The hidden detail is this. Spot price is the billboard, but the spread is the contract. The curve is the confession. And when the market starts paying up for now versus later, or when the relationship between near months and far months starts behaving weirdly relative to carry costs, it's not just a technical curiosity. It's a message. It's telling you whether there's urgency, whether there's tightness, whether financing is changing, whether someone is desperate to source, or whether paper trading is running ahead of physical reality. And the reason that matters is simple. Spreads force behavior. Behavior moves price. And forced behavior is what creates the violent, reflexive moves that dominate headlines and timelines. Think of it like this. Spot is the temperature you see on the weather app. The spread is the pressure system moving in. You can argue about temperature all day. Pressure systems don't care. They arrive. And when they arrive in markets, participants don't get to feel their way through it. They get margin called. They get asked to post collateral. They get forced to roll positions. They get forced to deliver. They get forced to hedge. The market doesn't negotiate with your narrative. It negotiates with your balance sheet. So let's build this properly, layer by layer, with mechanisms that actually explain why the conversation has shifted to metals. First layer, chart structure. Whether you're a fundamentals person or a macro person, the crowd still takes its cues from price. And the way price behaved recently was not boring inflation hedge. It was break, chase, and then a violent test. That pattern matters because it tells you who's in control. Breakouts that hold are about acceptance. Breakouts that spike and then flush are about discovery and liquidation. Discovery means the market is repricing. Liquidation means somebody was leaning the wrong way or over-levered. Both are fuel. The key difference is what happens after the flush. Do you get a messy, grinding failure where every bounce is sold? Or do you get a sharp rejection of lower prices followed by a reclaim where sellers can't push it down without immediately finding buyers? That's the fork. And that fork is exactly why metals are dominating the conversation, because people can feel that the fork is close and they're trying to front run the next branch. Second layer, macro regime, because the metals crowd has been trained to watch a few levers like religion, real rates, the dollar, inflation expectations. The old simplified story goes like this: dollar up, gold down, yields up, gold down, risk on, gold down. That story works often enough that it becomes a mental shortcut, and then it fails at exactly the wrong time, because regimes change. In a regime where the market is questioning policy credibility, where fiscal trajectories feel heavy, where reserve management becomes more geopolitical, where inflation is no longer a one-off anomaly, but an ongoing bargaining process between wages, energy, and supply chains, the correlations can twist. Gold doesn't tee out to need rates to fall to rise if the market believes the system is becoming more brittle. It doesn't need the dollar to crash if the why of the dollar changes. A strong currency can still coexist with strong gold if the bid is not a speculative bid, but a collateral and confidence bid. And if that sentence feels abstract here, as the translation, You can have a world where the dollar is strong because the world is stressed, and in that same stressed world, gold is strong because nobody wants to be the last one holding promises when liquidity thins. That's not conspiracy, that's incentives. Third layer, institutional behavior. Retail loves to talk about manipulation, but the smarter way to say it, without turning the whole thing into cartoon villain logic, is incentives and risk management. Banks run books, funds run mandates, hedgers run procurement schedules. Those entities care about volatility, basis risk, and funding costs more than they care about your Twitter thread. When those costs change, their behavior changes. And lately, the behavior that matters is this subtle shift. Gold and silver are being treated less like a niche hedge and more like a macro signal that can be ignored. The moment an asset becomes must own for risk parity reasons, or in insurance that might also outperform, flows shift from discretionary to systematic. Systematic flows don't ask permission. They don't wait for your perfect entry. They rebalance. They buy. They sell. They create reflexivity. And reflexivity is where the story gets spicy in a finance credible way. Because reflexivity is how small moves become big moves. It's how a simple breakout becomes a stampede. It's how a pullback becomes a trap. It's how the conversation suddenly becomes unavoidable because everyone sees the same thing and then everyone is forced to act in the same direction, but at different times, under different constraints. That's where the real pressure starts. Now, before we go deeper, let's cleanly separate gold and silver because they rhyme, but they don't behave the same. Gold is the confidence metal. It's the balance sheet metal. It's the reserve metal. It's the I want exposure without needing industrial demand to justify it metal. Silver is the hybrid. It's part money, part industrial input, part speculative accelerant. That hybrid nature is exactly why silver can look sleepy and then go feral. Its market is smaller, its liquidity can thin faster, and its demand narratives can flip from meh to urgent in a week if the wrong supply chain headline hits at the wrong time. And here's the part that tends to surprise newer investors. A lot of silver supply is not a silver mine turning on. It's byproduct. It's tied to the economics of other metals. That means you can just fix a silver shortage by writing a check and waiting 2 months. Supply responds on someone else's schedule. Refining and logistics are their own constraints. Recycling isn't a magic tap you can open instantly. So when demand accelerates, whether industrial procurement or investor demand, the market can get jumpy fast because it realizes the slack is limited. Now let's come back to the hidden detail. Spreads, term structure, and the quiet war between paper and physical. Futures markets are incredible tools, but they're also arenas for leverage. In a normal carry market, the future price tends to be higher than spot because holding metal costs money. You have financing, storage, insurance. The difference between spot and futures reflects those costs and the convenience yield of having the thing in hand. When everything is calm, the curve behaves. When stress creeps in, the curve starts talking. If nearby contracts get bid relative to the back months, if the curve flattens in ways that don't match funding conditions, if you see weird tension between immediate availability and later delivery, that's not just a chart nerd detail. It's a signal that someone is valuing immediacy. And that immediacy usually shows up for a reason. Either someone needs metal now for real-world reasons, or someone is navigating a position that can't be easily rolled without paying up, or funding conditions have shifted so sharply that carry trades are unwinding. Here's the simple version. Spreads are where the market prices time. And time is the one thing leveraged players can buy more of when they on the wrong side. If you're short and the curve moves against you, you don't just lose on price. You lose on the mechanics of staying short. Rolling gets expensive. Delivering becomes a headache. Margin pressure rises. Suddenly the I'll just wait it out strategy becomes a slow bleed. And slow bleeds end the same way. They end with forced decisions. That's why the spread is the lie detector. It tells you where the force is. And you can see the echoes of this in the way the metals conversation has shifted. People aren't just saying gold up. They're saying, why is gold up like this? They're saying, why is silver acting like it's smelling smoke? They're asking questions that only show up when the move feels like more than speculation. Because speculation alone can drive price, sure. But the moves that dominate market conversations, the ones that pull in macro watchers, skeptics, and even people who normally don't care, those moves have texture. They have mechanisms. They create follow-on effects. They change the way other assets behave. They force headlines. They force positioning. Let's stack proof in a way that's actually useful. 1. Recent price behavior was not a gentle drift. It was a repricing punctuated by a flush. That pattern often shows institutional involvement because it looks like bid hard, shake out, then see if anyone panics. 2. The macro backdrop has been unstable in narrative terms. 1 week the story is cuts soon, the next week it's cuts later, and the dollar and yields whip accordingly. That whiplash is exactly when metals shine as a trust asset because they don't require you to predict the exact meeting where a central bank pivots. They benefit from uncertainty itself. 3. The institutional framing has shifted toward physical fundamentals and evolving correlations matter, which is a fancy way of saying you can't just meme this away, and you can't just use the old one-factor model to trade it. 4. Silver supply dynamics are inherently constrained in the short run, especially when byproduct supply and refining lead times matter. 5. The structure, spreads, curve behavior, and the tension between immediate availability and forward delivery can start broadcasting stress before the spot price looks dramatic. And if you're only watching spot, you're late. But here's the catch, and this is where retail gets hurt. Late buyers and stubborn shorts both lose money in the same week. That sounds impossible, but it happens all the time in reflexive markets. The late buyers chase the spike, buy the top of the impulse, and get clipped on the flush. The stubborn shorts sell the spike, feel smart for a day, and then get forced to cover if the market reclaims key levels because their risk manager doesn't care that their thesis might be right eventually. In markets, eventually is a luxury product. Margin is real time. So if you want to understand why metals are dominating the conversation, you need to understand the positioning and margin spiral logic without getting lost in jargon. Picture a bunch of funds and traders short metals because they believe rates stay higher, the dollar stays firm, and the rally fades. Some of them are hedging, some are speculating. Price starts rising. At first it's manageable, then it keeps rising. The short book starts bleeding. Margin requirements can increase as volatility rises. Brokers ask for more collateral. At the same time, the rally can attract momentum buyers. Now the short isn't just losing, it's becoming crowded and painful. If price breaks a level that a lot of shorts were using as a line in the sand, risk models force reductions. Those reductions mean buying. That buying pushes price higher. Higher price triggers more reductions. That's a spiral. That spiral is not emotional, it's math. And that's why this move isn't emotion, it's math, even when it looks like emotion on a chart. Now layer in options, because options are where markets can turn from trend to snap. Options dealers hedge. If a lot of calls are bought and price rises through key strikes, dealers may need to buy the underlying to stay hedged. That buying can amplify the move. If price then falls back below strikes, the hedging can flip and dealers sell into weakness. That creates the whipsaw. This is why you can have days where metals look like they were being yanked by invisible strings, and the invisible string is actually just hedging flows responding to strike exposure. You don't need a villain, you just need a machine that mechanically buys high and sells low based on how exposure changes. That's why, when the market is perched near key levels, it can feel like a cliff edge. The next detail is what flips the whole setup. Okay, so what's the why now trigger? Why is this happening this week, this month, right now, instead of 6 months ago or 6 months from now? It's the calendar. It's always the calendar when the move accelerates. Month end and quarter end aren't just dates, they're forcing functions. Funds have to report, risk gets rebalanced, winners get trimmed, losers get cut, hedgers roll contracts, physical buyers lock in coverage, delivery windows matter, liquidity thins around certain periods, especially when people don't want to take fresh risk into a weekend or into an event cluster. And in thin liquidity, moves gap. That's how you get the sudden part that dominates conversation. It feels sudden to people who weren't watching the setup. To the participants who were watching the curve and the positioning, it feels like the inevitable moment when the system gets nudged and the dominoes start tipping. You'll notice how often big moves happen when liquidity is thin and the calendar is demanding action. That's not magic, it's just how a market behaves when it's forced to clear imbalances quickly. If everyone has plenty of time, they can negotiate price. If everyone has to move risk by Friday, price becomes a weapon. The market will push to the point where it forces the maximum number of participants to make decisions. That's why you get violent wicks. That's why you get fake breakdowns that reverse. That's why you get obvious breakouts that instantly pull back and test your conviction. And that's exactly why metals are consuming attention, because the market is not offering comfort. It's offering tests. Now, let's talk physical versus paper without going off the rails. The paper market is where liquidity is. Futures and ETFs make it easy to express a view. But physical demand is where the long-run truth lives, especially during stress regimes. When physical tightness shows up, it can show up as premiums, as delivery urgency, as inventory dynamics, as changing flows in trade. You don't need to invent secret numbers. You just need to understand the logic. If physical is getting tighter, the curve can reflect it. And participants who rely on the ability to source metal cheaply later start paying attention. Industrial buyers don't care about your chart pattern. They care about not shutting down a line, so they hedge, they procure, they lock coverage. That behavior can support price even when speculators get shaken out. And in silver, this matters even more, because industrial demand is not a footnote. Silver sits in electronics, solar supply chains, and a bunch of other applications where substitution isn't always trivial. If industrial users perceive risk, whether it's logistics, refining constraints, or just a pricing trend that threatens cost planning, they behave differently. They don't wait for a better entry. They manage continuity, and continuity management is a buyer that doesn't panic sell on a red day. That's why silver can feel like it has a floor that appears out of nowhere during certain periods. But again, that's not the part that matters. The part that matters is what those buyers force others to do. If physical demand firms up, shorts relying on easy availability can find themselves leaning against a tide. Now let's also address the counterpoints honestly, because if you can't steelman the bearish case, you're not investing, you're joining a team. The bearish case is straightforward. If economic data stays firm, if the market pushes rate cuts further out, if the dollar stays strong, metals can absolutely see more selling pressure. They can also see profit taking because they've run hard. You can get headline-driven flushes where the narrative flips overnight. You can get a scenario where geopolitical risk fades and the fear bid gets pulled. All of that is real. And any credible metals thesis has to include the possibility that the market chops, shakes, and even temporarily breaks down before resuming higher. Because the market's job is not to validate your worldview. Its job is to find the price that causes the most pain. So here is how you keep it finance credible. You define what would confirm the bullish regime and what would invalidate it. Confirmation looks like this. After pullbacks, buyers defend key zones quickly. Rallies are accompanied by supportive structure and spreads. Silver holds up relative to gold or reaccelerates after a retest, and the market stops reacting to every single cuts later headline with immediate collapse. Invalidation looks like this. Repeated failures to reclaim prior breakout zones, pullbacks that turn into a grinding downtrend, curve behavior that normalizes into comfortable carry without urgency, and silver underperforming in a way that suggests the speculative froth is unwinding without real support. Notice what I'm not saying. I'm not saying gold must go up because money printing. That's not analysis. That's a slogan. This is about what the market forces participants to do, because that's the only thing that moves price in the short run. Now let's talk about you, because your biggest threat in this environment isn't a wrong thesis. Your biggest threat is volatility as a psychological weapon. Even if you're right, the market can whip around violently and make you do something stupid. That's the trap. The market doesn't need to prove you wrong. It just needs to make you quit. It needs to make you sell the retest and buy the spike. And it does that by pushing your nervous system around with headlines and candles. One day it's metals unstoppable. The next day it's metals crash, and your brain starts chasing certainty. You start scanning for the one tweet that calms you down. That's how people get farmed. The antidote is simple and brutally unsexy. You separate trend signal from noise, and you size accordingly. Trend signal is structure holding and reclaiming levels after flushes, curve behavior that hints at underlying demand, and macro conditions that keep uncertainty elevated. Noise is a random intraday headline about one data print that gets overinterpreted. In this regime, the market will use noise to shake weak hands. That means your plan must include the expectation of ugly pullbacks. If your plan assumes the market will be polite, your plan is a fantasy. Here's a practical way to think about it without pretending you can predict the next candle. Use a two-scenario lens. Scenario 1 is the controlled pullback and retest. In this scenario, metals cool off, chop, and then reaccelerate as buyers defend a zone and the market rebuilds energy. This is the scenario that lures people into overconfidence because it feels healthy. It can still be painful because it takes time and it triggers impatience. Scenario 2 is the continuation squeeze. In this scenario, you get shallow pullbacks, fast reclaims, and gap risk, especially when liquidity thins around the weekend or around calendar forcing points. This scenario is exciting but dangerous because it can suck you into chasing and then punish you with a vicious snapback. Both scenarios can happen in the same month. Sometimes the market gives you scenario 2 first, then scenario 1. Sometimes it flips. That's why you need a roadmap instead of a prophecy. So what should you watch over the next week or two in plain English, without pretending we have a crystal ball? Watch the levels that mattered during the breakout and the flush. You don't need exact numbers burned into your retinas. You need zones, the prior breakout area, the recent highs, and the area where buyers stepped in during the dump. Watch how price behaves when it returns to those zones. Does it get rejected instantly, or does it grind and reclaim? That tells you whether sellers have control, or whether the selling is just profit-taking. Watch silver relative to gold. If silver keeps holding up and then starts leading again, it's usually a risk-on signal inside the metals complex. If silver collapses while gold holds, that can still be bullish for gold, but it's a different regime, often more insurance than squeeze. Watch how the market reacts to rate and dollar impulses. In a strong metals regime, you'll start to see metals absorb bad macro headlines without collapsing. That absorption is a tell. And if you want the hidden tell, the one most people will miss, watch the curve and the spreads. If urgency shows up there, it's telling you something deeper than a tweet thread can. Now, let's talk about the force actors. Who gets forced to do what if metals keep acting like this? Shorts get forced to reduce exposure if volatility and price both rise, especially near key technical levels. Options dealers get forced to hedge dynamically as price moves through strikes, amplifying moves in both directions. Industrial buyers get forced to hedge procurement if they believe prices will be higher later or availability could tighten. Funds get forced to rebalance at month end and quarter end, and that can create strange flows that look like manipulation, but are really just reporting and risk management. This is why you can get counterintuitive moves. A bullish thesis can still produce a brutal sell-off day if rebalancing demands it. That's not a contradiction. That's the machine. And here's why the conversation is so loud. Precious metals are one of the few places where macro, market structure, and real-world supply chain can all intersect in a way that ordinary investors can feel. You can't touch an interest rate swap. You can't picture a treasury auction mechanism emotionally. But you can picture metal. You can picture scarcity. You can picture paper promises versus physical. That makes metals a perfect narrative magnet during periods of institutional distrust. People argue about it because it's tangible. And when the chart starts moving, everyone projects their worldview onto it. That's why it dominates the timeline. Now, if you're a skeptic, and you should be, you might say, okay, but isn't this just another cycle where people get excited and then it fades? Sometimes, yes. Metals have absolutely had false dawns. That's why your framework matters. You're not here to marry a thesis. You're here to read the market's behavior and update. The reason this period feels different to many is that the move has been accompanied by signals of regime stress and by a sense that old correlations are less reliable. But even if that's true, the market can still punish you. It can still make you doubt the right idea at the wrong time. That's what it does. So here is the real play. Don't build your identity around being bullish or bearish. Build your identity around being disciplined, around watching the signals that matter, around understanding what forces participants to act, around having rules for what you do if price dips and what you do if price rips, and what you do if your invalidation level breaks. Because if you don't define invalidation, the market will define it for you, and it will define it at the moment you're most emotional. Let me make the invalidation idea concrete without giving you fake precision. If metals break down below the zones that held the repricing, and they can't reclaim quickly, that's a warning that the move may be transitioning from regime shift to mean reversion. If the curve normalizes into comfortable carry and the urgency disappears, that's another warning. If silver starts underperforming badly and can't recover, it suggests the speculative energy is draining and the industrial narrative isn't ET enough to compensate in the short run. In that situation, you don't need to catastrophize. You just need to adjust. Maybe you reduce exposure. Maybe you wait for a new base. Maybe you stop chasing. The point is, you're responding to the market, not pleading with it. Now, the payoff I promised at the start, what matters next week, and what breaks if a certain thing happens. Here it is. If the market continues to treat metals as a regime signal, you're likely to see one of two things. Either you get that controlled pullback and retest where metals shake out weak hands and then build a platform for another push, or you get the continuation squeeze where dips are bought aggressively and the move accelerates in thin liquidity. In the squeeze case, the danger is gaps and violent snapbacks, so you have to respect volatility. In the retest case, the danger is boredom and second guessing, so you have to respect patience. In both cases, the break is the psychological break. The moment you let headlines override your plan. That's what breaks first for most people, long before price breaks. And if you want the single metric everyone should care about, without turning this into a spreadsheet sermon, it's this. Does the market keep showing urgency in time, not just in price? Does it keep valuing immediacy, keep revealing stress through the way it prices near-term exposure versus long-term exposure? Because price can be pushed around by 1,000 narratives. Time is harder to fake when real participants have real deadlines. So here's your near-term checklist, spoken like a human, not a salesman. Watch the reclaim behavior after sell-offs. Watch whether dips get absorbed quickly or whether they turn into slow, weak bounces. Watch silver's behavior on red days. Does it snap back or does it fold? Watch the dollar and yields, but watch whether metals stop caring as much as they should. And watch the market around calendar pressure points, because that's when liquidity thins and the machine becomes loud. If you do that, you won't need to guess. You'll see the regime. And listen, this is the part where channels usually beg. I'm not doing that. If you're still here, you're already the kind of person who doesn't want narratives. You want mechanisms. You want to be early, not loud. You want to understand what the market forces people to do, not what they claim they believe. So keep your standards high. Don't get hypnotized by a green candle. Don't get terrorized by a red one. Let the structure tell you the truth. Let the curve whisper before the spot price screams. And if you want to stay sharp in this environment, stick around the people who are building process, not pumping excitement, because in a market like this, process is the only real edge.